Debt is invisible. You do not see it when you walk through a city. You do not touch it when you go to work. You do not hear it when markets open. And yet, it is everywhere. Behind every mortgage. Behind every corporate expansion. Behind every government budget. Behind every stock market rally. For decades, debt has been the silent engine of growth. It allowed governments to spend more than they collected. It allowed companies to expand faster than profits allowed. It allowed households to live beyond their current income. And as long as the system kept growing, the debt stayed manageable. That is how bubbles always form. Not through recklessness at first, but through success. Each year, more borrowing looked normal. Each year, higher debt felt justified. Each year, rising asset prices made the system appear stable. Until one day, the numbers stopped making sense. This is not a story about a single country. It is not a story about a single market. It is not a story about a single crisis. It is a story about a global system built on leverage. A system where almost every major institution depends on continuous borrowing to survive. A system where failure in one part can cascade into every other part. And a system where the costs of collapse do not fall on the people who created the debt. They fall on everyone else. This documentary is not about predicting a crash. It is about explaining how the modern debt system works, why it became so large, who benefits from it, who pays the price, and what happens when it becomes unstable. Because when a debt bubble forms, it does not burst quietly. It bursts through households, through jobs, through savings, through governments. And once it starts unraveling, there is no clean way to contain it. How the global debt system was built. To understand why debt has become so dangerous, we have to understand how it became so normal. In the past, borrowing was limited. Governments borrowed for wars or emergencies. Companies borrowed for expansion. Households borrowed for major purchases. Debt was a tool, not a foundation. That changed over time. As financial systems evolved, credit became easier to access. Interest rates fell. Banks became more aggressive. Financial products became more complex. Borrowing stopped being an exception and became the default. Governments discovered that debt was politically convenient. Raising taxes is unpopular. Cutting spending is unpopular. Borrowing allowed leaders to fund programs without immediate political cost. They could shift the burden into the future. And because economic growth usually continued, this seemed sustainable. Until it wasn't. Companies also embraced debt. Instead of saving profits to fund expansion, they borrowed. It was cheaper. It was faster. It boosted stock prices. Debt allowed companies to grow aggressively. Acquire competitors. Buy back shares. Invest in new technologies. All of this made executives and investors richer. And as long as revenue kept growing, the debt seemed manageable. Households followed the same pattern. Rising living costs. Stagnant wages. Easy credit. People borrowed to maintain their standard of living. Mortgages. Credit cards. Personal loans. Debt became a substitute for income growth. Instead of earning more, people borrowed more. This created a fragile balance. As long as interest rates stayed low and jobs stayed stable, the system worked. But that stability was an illusion. Another force accelerated this trend. Financialization. Instead of serving the real economy, financial markets began to dominate it. Banks created new debt products. Investors speculated on debt. Institutions packaged loans into complex securities. Debt itself became a commodity. Something to trade. Something to bet on. Something to profit from. This changed incentives. The goal was no longer sustainable lending. It was maximum volume. More loans meant more fees. More securities meant more trading profits. More leverage meant higher returns. Risk was hidden, not eliminated. And when risk is hidden, it grows. Another layer came from monetary policy. To prevent recessions, central authorities kept interest rates low. This made borrowing cheaper, which encouraged more debt, which inflated asset prices, which made people feel richer, which encouraged even more borrowing. This created a feedback loop. Low rates, more borrowing, higher asset prices, more borrowing. The entire system became addicted to debt. Any attempt to reduce borrowing threatened economic collapse. So borrowing continued. Year after year. Decade after decade. Until debt reached levels that would have been unthinkable in the past. This is how the debt bubble formed. Not through one reckless decision, but through millions of small, rational decisions. Each one made sense at the time. Together, they created a system that cannot survive without constant borrowing. Why the bubble became dangerous? Debt by itself is not a problem. Every modern economy runs on borrowing. The danger appears when debt grows faster than the ability to repay it. And that is exactly what has been happening. The first warning sign is debt saturation. When governments, companies, and households all carry high levels of debt at the same time, the system becomes fragile. There is no shock absorber. If one group struggles to repay, it affects the others. Governments rely on tax revenue from companies and workers. Companies rely on consumer spending. Households rely on stable jobs. When debt pressures hit one layer, the entire structure starts to shake. The second warning sign is declining productivity. Debt is supposed to fund growth. It is supposed to create new value. But over time, more and more debt has gone into unproductive uses. Stock buybacks, asset speculation, real estate bubbles, financial engineering. These activities inflate prices without increasing real economic output, which means future income does not rise fast enough to service the growing debt. This creates a debt trap. More borrowing is needed just to maintain the status quo. The third warning sign is interest sensitivity. When debt levels are low, small changes in interest rates do not matter much. When debt levels are high, even small increases can cause massive problems. Higher interest means higher mortgage payments, higher corporate debt costs, higher government interest expenses, which reduces disposable income, which reduces business investment, which forces governments to cut spending or borrow even more. This creates a vicious cycle. The fourth warning sign is moral hazard. When financial institutions know they will be rescued in a crisis, they take more risks. Because profits are private. Losses are socialized. This encourages reckless behavior. More leverage. More speculation. More risky lending. Because the downside is someone else's problem. This makes bubbles bigger and crashes more severe. The fifth warning sign is interconnectedness. Modern financial systems are tightly linked. Banks lend to each other. Funds invest in the same assets. Governments guarantee private debts. This means failure spreads quickly. A default in one sector can cascade into others. Not because they did anything wrong, but because they are connected. This is how local problems become global crises. Another danger comes from inequality. As wealth concentrates, debt becomes the only way for most people to survive. The rich do not need loans. The poor depend on them. This shifts risk downward. When the bubble bursts, the people with the least resources absorb the biggest losses. Savings disappear. Homes are lost. Jobs vanish. While those who created the bubble often survive. This is why debt bubbles are politically explosive. They feel unfair. Because they are. Another factor is complacency. When a system survives multiple near crises, people stop worrying. They assume it will always be rescued. They assume markets will always recover. They assume central authorities will always intervene. This creates a false sense of security, which encourages even more borrowing, which makes the eventual collapse worse. This is not a theoretical problem. It is a structural one. The global economy is now so dependent on debt that any serious attempt to reduce it would cause a recession. Which means no one wants to be the one to pull the brake. So the system keeps accelerating, even though everyone knows the road ahead is dangerous. Who benefits and who pays the price? Every debt bubble creates winners and losers. The difference in this case is how extreme the imbalance has become. The biggest beneficiaries are financial institutions. Banks earn fees on every loan. Investors earn returns on debt securities. Funds profit from speculation. They make money whether the economy grows or collapses, because they extract value at every stage. During the boom, they profit from lending and trading. During the crash, they profit from bailouts and asset fire sales. This creates a perverse incentive. The people who benefit most from debt growth are protected from its consequences. Another beneficiary is asset owners. As debt expands, asset prices rise. Real estate becomes more expensive. Stocks become more expensive. Financial instruments become more valuable. People who already own assets get richer. People who do not get locked out. This widens inequality. And inequality fuels more debt. Because people borrow to try to catch up, which inflates the bubble further. Governments also benefit in the short term. Debt allows them to fund programs without raising taxes. It allows them to delay hard decisions. It allows them to appear competent. But this benefit is temporary. Eventually, debt service costs consume budgets, which forces spending cuts, which triggers political backlash, which destabilizes governance. The people who pay the price are households. When a debt bubble bursts, ordinary people lose everything. Jobs disappear. Savings evaporate. Homes are foreclosed. Pensions shrink. Even people who never borrowed much suffer. Because they lose income. They lose social services. They lose security. This is what makes debt crises so destructive. They punish the innocent. Another group that suffers is small businesses. When credit dries up, they cannot survive. They do not have cash reserves. They cannot borrow cheaply. They collapse quickly. This destroys local economies, which increases unemployment, which reduces tax revenue, which worsens government finances. This is how a financial crisis becomes a social crisis. The final group affected is future generations. Debt shifts costs forward in time. It allows the present to consume resources that the future will have to pay for. When the bubble bursts, young people inherit weaker economies, higher taxes, lower wages, fewer opportunities. This creates intergenerational conflict, which destabilizes societies. This is the dark truth about debt bubbles. They are not just financial events. They are political events, social events, moral events. Because they redistribute pain in profoundly unfair ways. What happens if it pops? If a debt bubble bursts, the process is not clean. It does not happen in a single day. It unfolds in stages. The first stage is panic. Markets fall. Credit freezes. Investors rush to sell assets. This destroys confidence, which makes the crisis self-reinforcing. The second stage is contraction. Businesses cut spending. Consumers stop buying. Governments slash budgets. Unemployment rises, which reduces income, which increases defaults, which worsens the crisis. The third stage is intervention. Central authorities step in. They lower interest rates. They inject money. They rescue banks. This stabilizes the system. But it also increases debt even more, which delays the problem instead of solving it. The fourth stage is stagnation. Economic growth remains weak. Wages stay low. Investment slows. The economy becomes dependent on constant stimulus. This creates a lost decade. Not because nothing happens, but because nothing improves. The final stage is political fallout. People lose faith in institutions. They reject mainstream politics. They support radical movements. This creates instability, which makes economic recovery harder. This is why debt bubbles are so dangerous. They do not just destroy wealth. They destroy trust. And trust is harder to rebuild than money. Debt is not just a financial issue. It is a political issue. A social issue. A moral issue. It shapes who gets ahead. Who falls behind. Who pays for mistakes. The modern economy is built on borrowing. And as long as that borrowing keeps growing faster than real income, the system becomes more fragile. This does not make collapse inevitable. But it does make stability conditional. Because once debt stops working, nothing else does. If you want to understand how money, power, and economic systems are quietly reshaping the world, subscribe to this channel. Each week, we break down the forces behind the headlines. Not with hype. Not with fear. But with calm, long-form explanations. The next episode explores another hidden shift already changing the economy. Because the most important transformations rarely announce themselves. They simply happen.